Today, we're talking about asset allocation and 5 things that you need to know about asset allocation in your portfolio right here, right now. Stay tuned. I'm Rob Tatro from robtatro.com, Senior Portfolio Manager here at Canaccord Genuity Wealth Management and the Tatro Wealth Advisor Group. Today's a good one. We're talking asset allocation. This is a topic that is forever confounded and messed people up and got them all confused. The key with asset allocation is that there are 5 tips, and I'm going to cover them in this video. Before we do that, don't take a sec to like, subscribe, share, follow, give us your comments. We'd love to hear your thoughts on asset allocation, but don't forget to subscribe. Press the red button there, subscribe to our YouTube channel. Do it right now. Also, if you'd like to book a no obligation consultation, please go to www.speaktorob.com. We'd love to book a chat with you to discuss this or anything else that's on your mind. All right, asset allocation. Asset allocation, let's start from the top. First thing, it's a technique that aims to balance risk by dividing assets across a whole bunch of different asset classes or asset categories. Some asset classes include stocks, some include fixed income or bonds, and another might be alternatives. Okay, those are the 3 main asset classes that we use when we make asset allocation. Now, there are others such as derivatives and cash and commodities. But for the purpose of our discussion today, the 3 major asset classes are stocks, fixed income, and alternatives. Okay, so let's take a look at those 3 asset classes. First things first. So stocks historically will give you the best return, overall net return likely to be in stocks. Okay, they've had a really long track record, and it's more of a proven commodity. It's a proven thing. You know that stocks long-term will be up. They've got a 150-year track record. If you own stocks and you have a long investment horizon, you're going to do well. Now, one thing we also know is that you're going to get a lot of volatility. Stocks have the highest volatility. So that would be the risk-reward trade-off. You get the highest return, but the highest volatility. The second asset class, fixed income, otherwise known as bonds. Now, there are more than just bonds and fixed income, and we'll get to that in a sec. But traditionally, fixed income is an interest payment, so highly taxable, interest payment, a regular, either monthly or quarterly income that gets paid to you as a holder with very little or no upside for growth. Okay, so you basically get paid to lend your money to someone. So you might own a company, that would be stocks or equities, but you might also own the debt for that company. If you own the debt for that company, you are lending them money. They are using that cash to do whatever their purpose is, and they are paying you a coupon, a fixed income amount every month for your cash, or every 6 months or every 3 months. The third asset class is alternatives. Now, I've spoken a lot about alternatives. I'm a big believer in alternatives, and I've got a lot of videos on this channel about alternatives and why they belong in your portfolio. I believe every Canadian should have a piece of alternatives in their portfolio. They provide phenomenal total returns. They provide incredible tax efficiency. It's completely uncorrelated to the stock market. It does wonders for risk-adjusted returns. It protects the capital, and it allows you to be tactically shifting assets in times of market despair. So I'm a big believer in alternatives. You should have some. Whoever you are watching this video, you should have some alternatives. If you don't have any in your portfolio, and I don't mean long shorts and I don't mean hedge funds, I mean real alternatives. Asset classes that produce income that is uncorrelated to the stock market. Income and growth uncorrelated to the stock market. Stuff like private real estate, stuff like music royalties, private infrastructure, farmland, private equity, maybe some private debt. All of those are asset classes that are not traditional stocks or bonds. Okay. So I believe you should have alternatives. I don't know your risk tolerance. Maybe you should have 20%, 30, 40, 50%. I don't know, but you should have some. Every pension manager on the planet, the largest endowment funds, they all have a hefty or a nice chunk asset allocation to alternatives. And yet most Canadians have none. Most Canadians have none. I see statements all the time. People come to us and they go, here's my statement. I'm at blah, blah, blah investment firm. And lo and behold, 60% stocks, 40% bonds. It's unfortunate. It's very unfortunate because you're missing out on an entire asset class that will improve your risk-adjusted returns almost undoubtedly. And if it's done well with a good senior portfolio manager, you can dramatically improve your returns and reduce your risk. So back to asset allocation. It's the percentage that you're allocating to each of these different asset classes, okay? In theory, you want to have a reverse correlation with each other. So when Markowitz kind of went back in the day and he developed a theory about the efficient market frontier, he said, you're better off to own a little bit of bonds, than just stocks, because you're going to get way less risk and your risk adjusted returns are going to be better because bonds move inversely to stocks. Well, that was back in the day. Nowadays, we don't see that as much. In 2020, when the market crashed, the bonds got hammered as well. They were down 10, 12, 15%. So the reverse correlation or the inverse correlation no longer really exists between bonds and stocks. So you really want asset classes that complement each other. So if one is going up, the other is either staying flat or paying income or doesn't really care what's happening to the other asset classes. At its root, most of the asset allocation, most of the management decisions made by portfolio managers, guys and gals like me, the root of it is asset allocation. If you build a proper asset allocation portfolio for the right client, based on their personal needs, based on their income situation, their tax situation, their liquidity situation, their retirement situation, their estate situation, if you build a perfect portfolio, actually considering all that, asset allocation is a good chunk of that. It's a big, big, big piece of that. Stock selection is important, but asset allocation is a big, big piece. So we know that risk and return, we know that stocks will perform the best with the most volatility. We know that bonds will perform the worst with the least amount of volatility. And we know that alternatives are somewhere in between. What I would tell you, so that's the first point, risk and return. The second point that I would tell you is don't just use online questionnaires and don't just use online softwares to figure out your asset allocation. They are not well built and they don't understand you. They don't understand your tax situation. They don't really understand the root of you. Our job is to make sure we understand how clients react when there's market shifts, when there's market movements. Because if there was no emotion here, if there was no emotion in investing, everyone would have 100% growth stocks in their portfolio, right? Because you would want the best absolute total return. And where do you get that? You get that in growth stocks, right? You get way more volatility, and there are periods where you're losing a ton of money, but long term, you're going to get way more returns. The reason we do asset allocation is because you, at the end of the day, need to be sleeping at night. You need to have that emotional comfort knowing that your money's there. And not everyone sleeps the same amount of hours based on their portfolio. What I mean by that is someone might freak out if they're down 5%. Others might not care unless they're down 20, and others might really not care unless they're down 40. And others, like me, sleep regardless, and they just see that as a tactical shift in the market and they see opportunities. So based on that situation, don't rely on online software. I just don't think it's a good tool. I think you definitely need to work. If you don't know your asset allocation, you don't know your risk tolerance, you definitely should be working with a professional to figure that out, because otherwise you're going to set yourself up for failure. You want to optimize your wealth, right? And that means getting the most amount of return for the volatility that you're willing to take. Point number 3, know your goals. All right. We have goals and we all aspire to retire. And I talked about understanding your asset allocation based on your goals. So your asset allocation is based, I said, your tax situation, your retirement, all that. What's your goal with your investing, right? Is it just to park money for a few years? Is it to form a future income stream for your retirement? Is it multi-generational wealth that's going to go to your kids and their kids? Is it to donate to a charity that you really, really like? You cannot build a proper asset allocation. You cannot build a proper portfolio unless you truly know the goals. That's why every time I sit down with a client or a prospective client, this is what I get to. What's the root? What's happening with this money? What do we want to do here? Once we find out what we want to do, then we can build a portfolio, we can build asset allocation. At the end of the day, generally for me, I like clients to have some alternatives. I like clients to have some stocks, and the fixed income is a bit of a wild card because it's yielding so little right now, right? It's yielding so little that traditional fixed income, like straight up bonds, corporate bonds and government of Canada bonds, you're getting less than 2% on a 10-year yield. So that really doesn't leave much if you're talking about taxes, if you're talking about, fees, if you're talking inflation. It becomes a tough asset class to defend. Plus, we're talking about a potential rising interest rate environment where as interest rates rise, bonds are worth less and less. So it's a bit of a complicated situation to add traditional fixed income. So we're big believers of alternative fixed income. You can look at having maybe some notes, structured notes that are guaranteed. You could look at having some alternative income vehicles. You could look at having some private debt or mortgages. You do have to be careful because there's a lot of products that exist here and some of them sometimes go belly up. So you really need to make sure the individual who's making these decisions for you knows this game because you don't want to get burnt there. Finally, the fourth point, time is on your side, right? So with your asset allocation, a lot of people are going to factor and consider, oh, well, I'm at 65, I'm retiring. Therefore, my asset allocation needs to be all cash when I'm 65. Well, no. So first off, if you're 40, time is on your side. You got 25 years before you need to draw on this income. So you probably want to have an asset allocation that's more geared towards stocks and alternatives. There used to be a rule when I started as a portfolio manager way back in the day. They used to say your age should be your percentage of fixed income. So if you were 20, you should have 80% stocks, 20% fixed income. And if you were 70, you should have 70% fixed income and 30% stocks. I can't think of a more absurd rule nowadays. If your portfolio manager subscribes to this rule, I think it's preposterous and I think it's absurd because interest rates used to be at 6 or 8 or 10%. So you could generate a portfolio to get 8, 9, 10% returns, even if you had 50, 60, 70% fixed income. That's no longer doable. And based on your needs, that might not be doable. So just the fact that you could have a basic rule based on age is completely absurd. It forgets to take into account tax. It doesn't take into account risk, and it doesn't take into account your personal situation, right? And your goals. So I think it's absurd. I think it can form part of a general rule, which should be the older you get, generally people become more risk averse, but it's not necessarily because they're old or they're dying. It's because nature changes you as a human being, right? So, and typically you're going to have a cash need in retirement. So if you have a cash need, you need to make a plan. All right. How much are we drawing down on the portfolio every year? Where are we going to draw that income from? Where are we going to get it from? And how are we going to create that income? So if you need 5 or 10% income every year from your portfolio, how are we going to structure that? Are we selling actual assets every year to pay for you? If yes, we got to make sure that we have enough assets that are liquid, that can be converted to cash without penalty, without risk of market, for you to ride out a recession or ride out a crash. So in other words, if you're 100% stocks and you need to pull out 10% of your portfolio every year and there's a 30, 40% crash, you're going to have to sell some stocks at a significant loss. And we don't want that. Therefore, if you're drawing down your portfolio, you need to have a portion that's either fixed income, some sort of traditional liquid fixed income, or alternatives, just so you can generate cash should you need it. The last part I'll say is just implement it. Okay. The fifth point is implement. Make a plan, implement it, and stick to it. Okay. It's very easy to take a look at asset allocation and change your mind over time. And we get greedy as human beings. Okay. So we will see in a position where we have 80% stocks and 20% alternatives, or maybe 20% fixed income. And all of a sudden the stocks have done really, really good. And maybe you're up 20 or 25 or 30% in your stocks, and yet you only made 4% in your fixed income, or you only made 9% in your alternatives. And you think, why do I have that in my portfolio? That's ridiculous. I want to make more money. I want to be greedy. So what ends up happening? You sell the fixed income, you sell the alternatives, and now you're 100% stocks. And usually you're doing that right at the top of the market. So you're buying assets right at their peak because it's emotion. It's a cycle of emotions. You get greedy at the top, you get fearful at the bottom. So we want to avoid that. The reason you own that, remember, why do I have my asset allocation? Probably there's a reason, probably for tax, maybe for income, maybe for liquidity needs, whatever the reason is, provided it's based on reason, provided it was planned out, and provided it was done with a professional, you got to stick to it. And there's a reason behind it. And the reason is likely so that if there is a crash, you have opportunity to buy, right? So when you're building that plan, do it, but stick to it and implement it. Don't be greedy, right? Because that's going to end up costing you long-term. If you'd like to book a no obligation consultation, go to www.speaktorob.com. We'd love to book that chat with you, chat about this or anything else that's on your mind. I'm Rob Tatro, Senior Portfolio Manager at Canaccord Genuity Wealth Management and the Tatro Wealth Advisory Group. This is what we do. I'm passionate about this stuff, and I would love to hear your thoughts, to hear your comments. Take a sec to subscribe, and I will see you in the next video. Thanks for tuning in.